Most retirees are unknowingly losing tens of thousands of dollars, not because of a bad investment or a market crash, but because they don't understand how Social Security really works. The system was never designed to maximize your benefits without strategy. In fact, one wrong move could permanently reduce your income for life. And here's the worst part. You can't fix it later. There's one crucial detail that changes everything, and most people find out when it's already too late. The hidden cost of claiming. Too early. Every year, millions of Americans make the same decision. They claim Social Security at age 62, the earliest possible age. On the surface, it feels like the right move. After all, why wait to receive money you've paid into for decades? But here's the truth. Claiming early can quietly rob you of hundreds of thousands of dollars over your retirement. When you claim at 62, your monthly benefit is reduced by up to 30%, permanently. And that reduction doesn't just affect your monthly income, it impacts your cost of living adjustments, survivor benefits, and even your Medicare premiums in some cases. You don't just lock in a lower number, you lock in a lower lifestyle. Let's break it down. If your full retirement age is 67 and you're eligible for $2,000 per month, claiming at 62 drops that to around $1,400. That's $600 less per month every month for the rest of your life. Over a 25-year retirement, that's a loss of $180,000, not including inflation adjustments or the impact on a surviving spouse. Now, here's where it gets worse. Americans are living longer. A 65-year-old today has a nearly 1 in 2 chance of living past 85. And if you live longer, that lower benefit haunts you every year. This is why Warren Buffett always emphasizes long-term thinking over short-term gratification. It's not about when you get the money. It's about how long you'll need it to last. So the question is, are you willing to trade a few early checks for decades of lower income? The real truth about COLA, cost of living adjustments. Every year, Social Security announces a COLA, a cost of living adjustment that's supposed to help retirees keep up with rising expenses. But here's the hard truth. These increases rarely keep up with the real cost of living, especially for retirees. And over time, that shortfall can quietly destroy your purchasing power. Let's look at the facts. In 2022, the COLA was 5.9%. Sounds decent, right? But healthcare, one of the biggest expenses for retirees, rose more than 7% that same year. Medicare premiums, prescription drugs, supplemental insurance, all of it got more expensive faster than the COLA increase. And the story doesn't end there. Groceries, utilities, housing, transportation, the essentials, have been rising at rates that outpace COLA adjustments almost every year. So while your benefit might technically go up, your buying power is shrinking. That's what's called stealth inflation, and it's one of the most dangerous threats to retirees. Warren Buffett warns that inflation is like a silent tax. It swindles almost everybody, he once said. And for retirees living on a fixed income, it can be devastating. Relying on COLA to protect your lifestyle is like using a paper umbrella in a storm. It's better than nothing, but it won't hold up over time. That's why smart retirees plan beyond COLA, building strategies that include inflation-resistant income sources, tax planning, and spending controls. So ask yourself, if prices keep rising like they have in recent years, how confident are you that your Social Security check will still cover what it does today? The earnings test trap. It's one of the most common and costliest mistakes retirees make. Claiming Social Security early and continuing to work, thinking they're stacking income. But what many don't realize is that doing this can trigger the earnings test, which reduces your Social Security benefits. And for some, by thousands of dollars a year. Here's how it works. If you claim Social Security before your full retirement age, between 66 and 67 depending on your birth year, and you keep working, you're subject to income limits. In 2025, if you earn more than $22,320, the Social Security Administration will withhold $1 for every $2 you earn above that limit. Let's break that down. Imagine you start receiving $1,500 a month in benefits at age 63, and you work part-time earning $32,000 that year. You're $9,680 over the limit, which means Social Security will withhold about $4,840 of your benefits. That's more than 3 months of checks gone. Now, here's what's important. That money isn't lost forever. Once you reach your full retirement age, your monthly benefit is recalculated to give some of it back. But it takes years to break even, and if you don't live long enough, you never fully recover that withheld amount. This is why Warren Buffett always says, never risk what you have and need for what you don't have and don't need. Jumping the gun on benefits without understanding the rules can cost you in ways that aren't obvious up front. So before you claim early and keep working, ask yourself, are you gaining income or just setting yourself up for a delayed payback that may never fully come? If this is opening your eyes, just imagine what you don't know yet. Most people miss critical Social Security strategies simply because no one ever told them. And by the time they find out, it's too late to fix. Don't let that be you. Make sure you subscribe right now so you don't miss the next strategy that could save you thousands, or even protect your retirement entirely. Because once you make the wrong move, there's no going back. The tax surprise. Most retirees are shocked to find out that their Social Security benefits, the same ones they paid into for decades, can be taxed again. And not just a little. Depending on your income, up to 85% of your Social Security can be counted as taxable income. It feels unfair, but it's real, and it blindsides millions every year. Here's what most people don't realize. The IRS uses a formula called combined income to decide how much of your benefits are taxable. This includes your adjusted gross income, AGI, any tax-exempt interest like municipal bond income, and half of your Social Security benefits. If that combined number exceeds $25,000 for individuals or $32,000 for married couples, a portion of your benefits becomes taxable. The higher your income, the larger that portion gets, up to 85%. Let's say you're a married couple with $30,000 in Social Security and another $40,000 in retirement withdrawals. That adds up to $55,000 in combined income, well above the threshold. Result? You could end up paying taxes on 85% of your Social Security. This is where retirement gets tricky. Many people build a nest egg, assume their income is tax efficient, and then get hit with this surprise. It can turn a comfortable retirement into a tight one, fast. But there are smart ways to plan around it. Using Roth IRAs, timing your withdrawals, delaying benefits, or strategically converting traditional IRAs can all reduce your taxable income and keep more of your Social Security in your pocket. Warren Buffett often says, it's not about how much you make, it's about how much you keep. And when it comes to retirement, what you keep after taxes is what determines your freedom. The spousal benefit loophole. Most couples miss. There's a little-known strategy in the Social Security rulebook that could be worth tens of thousands of dollars to married couples. Yet most never take advantage of it. It's not a trick or a gimmick. It's a built-in part of the system. But if you don't know it exists, or if you make one wrong move, you could miss out on a major stream of income for life. Here's the deal. A lower-earning spouse is eligible to receive up to 50% of their partner's full retirement benefit, even if they didn't work enough to qualify on their own. It's called the spousal benefit, and it's one of the most underutilized features in Social Security. Let's say Bob qualifies for $2,600 a month at full retirement age. His wife, Carol, only qualifies for $900 on her own. If she claims spousal benefits correctly, she could receive up to $1,300, adding an extra $400 per month or $4,800 per year to their household income. Over a 20-year retirement, that's $96,000 in additional income, not including cost of living increases. But here's where it gets tricky. To qualify for the full spousal benefit, the higher-earning spouse must have already filed for their own benefit. And if the lower-earning spouse claims early before their full retirement age, the amount is permanently reduced. Plus, many people don't realize that you can't double dip. You'll either receive your own benefit or the spousal benefit, whichever is higher, not both. There's also a major survivor benefit impact. If one spouse passes away, the surviving spouse may be eligible to receive the higher of the two benefits. But again, if the original claiming strategy wasn't done right, this survivor benefit could be much lower than it should be. Warren Buffett often reminds us, opportunities don't shout, they whisper. The spousal benefit is one of those quiet, powerful opportunities that, if used correctly, can transform a retirement plan. Medicare's hidden connection to Social Security. Most people think Medicare and Social Security are two separate systems, and on paper they are. But in reality, they're deeply connected. And if you don't understand how they interact, it could cost you thousands in unexpected premiums. Here's what surprises many retirees. If you're receiving Social Security at age 65, you'll be automatically enrolled in Medicare Part B, the part that covers outpatient care and doctor visits. The premium for Part B is deducted directly from your Social Security check. So far, so good. But here's the problem. That premium isn't the same for everyone. It's based on your income from 2 years ago, thanks to something called IRMA, the Income-Related Monthly Adjustment Amount. If your income was above $103,000, individual, or $206,000, married, in 2023, you'll pay significantly more for Medicare in 2025. And it can get expensive, fast. Even worse, one-time income events, like selling a house, taking large IRA withdrawals, or converting funds to a Roth, can push you over the threshold, triggering IRMA surcharges you didn't see coming. Some retirees go from paying $174 per month for Part B to paying over $500, and they had no idea it was coming. This is exactly the kind of fine print Warren Buffett warns people to pay attention to. The government doesn't send you a warning. You simply receive a letter, and then the higher premiums start showing up. Smart retirees plan ahead, spread out large withdrawals to stay under IRMA thresholds, time conversions and asset sales to avoid triggering higher brackets. Work with a tax advisor who understands how Medicare premiums are calculated. In retirement, it's not just about how much you saved, it's about how efficiently you use it. And when Social Security and Medicare collide, the cost of ignorance can be steep. The one move Warren Buffett would never make with Social Security. If Warren Buffett were deciding when to claim Social Security, there's one move he absolutely wouldn't make. And that's claiming early out of fear of dying early, fear of missing out on money, fear that the system will run out. But Buffett doesn't build his fortune on fear. He builds it on long-term thinking. And that's exactly what most people overlook when it comes to Social Security. Here's the mistake. Millions of people claim benefits at 62, the earliest possible age, because they think they need to get what they can while they can. But doing that reduces your monthly benefit by up to 30% for life. And if you live longer than expected, which many do, that reduction compounds into a huge lifetime loss. Let's say your full retirement benefit at 67 would be $2,000 a month. At 62, you'd only get around $1,400. That's a $600 difference. Over 25 years, that's $180,000 less, not including cost of living increases. That decision doesn't just affect you, it affects your spouse's survivor benefits too. The Social Security Administration estimates that a man who reaches age 65 today will live, on average, to age 84, and a woman to age 87. That means you could be collecting benefits for 2 or even 3 decades. And every extra dollar matters more the longer you live. Buffett always says, someone is sitting in the shade today because someone planted a tree a long time ago. Delaying your benefit may feel like a sacrifice now, but it's one of the smartest ways to secure your financial shade later in life. So ask yourself, are you thinking like an investor or reacting like a gambler? Ask yourself this, how many more years can you afford to make the wrong financial moves in retirement? Social Security, taxes, Medicare, these aren't just details. They're make-or-break decisions that impact every dollar you've saved. If you found this information helpful, this is your moment to take action. Hit that subscribe button right now, because the strategies that will protect your future aren't in the headlines, they're here in the next video. Don't let confusion or delay cost you your security. Subscribe today, while you still have time to plan.